We are taught that the economy is a decentralized arena of competition, a system where millions of independent actors drive prices through constant, localized collisions. By the first quarter of 2026, the scale of those actors changed. One firm's assets under management reached $14 trillion. This figure exceeds the annual economic output of Germany and Japan. This chart shows BlackRock's managed capital rising to a level that rivals the total GDP of the United States. Under founder Larry Fink, the firm has secured a concurrent equity stake in nearly every major corporation. From energy to technology, the same shareholder sits at the top of the ledger. Individual consumers now participate in an economy where a single firm often holds a major stake in the manufacturer, the bank, and the retirement fund simultaneously. The path to this level of control began with the 2008 financial collapse. As subprime mortgages failed, the banking sector faced a total systemic freeze. To manage the fallout, the Federal Reserve needed a private partner to process billions in failing assets. They bypassed the traditional competitive bidding process and awarded the contract to BlackRock. This created a unique position of influence. BlackRock was advising the government on how to buy the toxic assets, while they were simultaneously helping the banks sell them. The 2008 crisis permanently shifted BlackRock's role. They moved from the periphery of the market to becoming a permanent component of the state's financial infrastructure. This consolidation is managed by Aladdin, a proprietary AI system designed to calculate risk across every asset class in existence. This network monitors more than $21 trillion in global assets. It is used not just by BlackRock, but by central banks, pension managers, and the firm's own competitors to determine their next move. In 2023, data scientist Hamdan Azhar filed a whistleblower lawsuit alleging that BlackRock used trend spotters to feed Aladdin alternative data streams, such as social media sentiment and retail investor flows. The lawsuit claimed this surveillance allowed the firm to move ahead of the market. By predicting the behavior of millions of retail investors, Aladdin could execute institutional trades before the rest of the market could react. Because so many institutions rely on the same AI, they often move their capital in the same direction at once. This creates a synchronized market behavior that makes it difficult for outside regulators to identify or manage systemic risks. This data advantage eventually moved from the stock market to residential streets. Institutional investors and their subsidiaries have acquired over 450,000 single-family homes across the country. In markets like Atlanta and Phoenix, these institutions have purchased up to 30% of the available housing. Many of these acquisitions were cash deals executed without a physical inspection. This visualization shows the divide in purchasing power. A family might save for 8 years to afford a home. An algorithm can identify that same property and close a cash bid in seconds. Internal memos from 2019 revealed this was a calculated move. The firm reclassified single-family homes as an emerging asset class for large-scale institutional investment. Using asymmetric data, these firms have converted a primary vehicle for middle-class wealth into a predictable institutional revenue stream. The final frontier of this expansion is the sovereign debt of the United States. Through products like the BUIDL fund, BlackRock has already moved over $500 million into tokenized treasury assets. Tokenization converts traditional government bonds into code on a digital ledger. This ledger is built and managed by BlackRock, creating a private environment for the trading of public debt. This shift means the firm is no longer just a buyer of government debt. They are now the operator of the digital infrastructure required for that debt to function. Despite this level of integration with the state, the firm has avoided the strictest forms of federal oversight. They successfully lobbied to avoid being labeled a systemically important financial institution. Without this designation, they are not required to undergo the same rigorous stress tests as the nation's largest banks. To maintain this environment, they have spent millions on lobbying. This capital is used to block legislation limiting institutional ownership of family homes. Addressing this consolidation requires specific actions: auditing the managers of local pension funds, tracking corporate home ownership in your community, and calling for legislative oversight of the Aladdin network. This system thrives when its operations remain technical and invisible. Public wealth is the primary tool for restoring a competitive market.